You may not realize, but Nifty hasn't moved a lot in the last 2 years. So here's the problem. You're a long-term investor and want to generate some money on top of your long-term holdings. So today we'll learn a strategy on how you can use options and your long-term holdings to actually generate some money even when markets are down, sideways, or move up just a little bit. Even in these 3 scenarios, you will make some money. But there's a catch. You have to make sure you understand what I tell you. So watch the entire video till the end and follow exactly what I say and understand the risks in how this works. But before we get to strategy rule number 1, please like and subscribe right now. So rule number 1 is simple. So the first condition is that you should have long-term holdings in blue chip stocks, which is basically what? Large cap. So I'm talking about HDFC Bank, I'm talking about TCS, Reliance, etc., etc., etc. These stocks are the only stocks you can use this strategy on. Second, you should have a long-term bullish view on the stocks that you hold. So over here, when we said blue chip stock, I basically mean F&O stocks. So if these stocks are in the F&O universe, then you're gold. Second, you must have a long-term view on these stocks and you already hold them in your portfolio for whatever reason because you believe in them. If you're a trader, this won't work. You need to be believing in these companies for 5, 10, 20 years, then this will work. And third, you have to have F&O equivalent lot size. So, for example, Reliance has these many shares as the minimum lot size. You have to hold this much quantity of Reliance for this to work. If you own a smaller quantity than this, then this won't work. But even if you do own a smaller quantity, it doesn't matter because in the future, with all the bonuses, dividends, and the wealth you'll make over the next few years, you'll eventually get there. So watch this video till the end. So when you're ready, you can actually use this strategy. So let's see a real example. Today is 8th of August, but actually we should have done this around 28th of July when the new expiry actually began. But that's fine. We'll look at today's prices and we'll also look at the start of the expiry prices to understand what this strategy is. And I'm going to open Reliance. So if you open Reliance here, you'll see roughly Reliance has been in the same space for the last few days. Not a lot of change. And let's assume we actually own 200 shares of Reliance. Why 200? Because one lot size of Reliance in futures and options is 200. So you can own multiples of 200 in your portfolio. If you do own 200, 400, 600, 800 shares, then this will work really well. So what we'll do is, simply put, about 5% away from the current market price, let's say around 2650, we will see a call. Now I'll do is I'll open and I don't see 2650. So over here on the option chain, I see 2640. So perfect. I'll use 2640 as the strike price. And we have the option right now. It's priced at 11 rupees. But today is 8th. If we actually go back in time, around the start of the expiry, it was 25 rupees. What we'll do is we'll short this call. That's it. We'll short this call and we'll collect the premium that is this much rupees. Now, the margin for this is actually high. I'll give you a hack on how to work with that. But the premium that you see over here, once we sell the call, we will receive this much as premium. Now, if this call option goes to 0, we get to keep this entire amount. Now, at 25 rupees multiplied by the lot size, this is roughly 1% of your cash investment. Now imagine if you earn this 1% every month for 12 months, you've earned something. There'll be some days, some months where you don't earn anything, and we'll talk about the risks and what that looks like. But just to give an idea, you can earn that extra 1% every month based on this. But it can't be so simple, right? So let's see all the 3 scenarios of where we made money, where we lost money, and why. So in summary, you already own some blue chip stock and you believe in its future. 2, you want to generate some return on top of this when markets are sideways or down. And in this example, we picked Reliance. And in this case, the price of the option right at the start of the expiry was 25 rupees and we sold that call. Now all we need is the market to do 3 scenarios. And in 3 scenarios, let's see how much we actually made. I'll give you the answer before I actually show you. We would have made 1% on our total investment of the Reliance shares. So imagine if you made 1% for a few months, what that would be on top of your investment. But let's understand the risks and the 3 scenarios. So what have we really done? We have sold calls worth X amount at 2640. Add the 25 rupee premium Reliance was at the start of the expiry. Anything below 2665, if Reliance is on the expiry date of August, we will make money. Now this is interesting. If the market rises a little bit, you'll still get to keep that premium. If the market is sideways, you get to keep that premium. If the market falls, you get to keep that premium. Now, when I say get to keep that premium, the value of that option will actually go to zero. Remember, we shorted at 25. So if it goes to zero or near zero, that entire portion we get to keep. And that is our profit. But let's understand what happens if markets go above 2665. So let's say the market closes at 2675, right here. That's above our break-even point of 2665. How much money do we lose? Well, we basically lose 10 rupees because the call option is now priced at 35. We shorted at 25. So 10 rupees multiplied by 200 and we lost 2000 rupees on this single trade. However, we also own the shares of Reliance, right? So the run-up of 200 shares is 150 points multiplied by 200, that's 30,000. But if you see this from a long-term investing perspective, you are bullish on the stock, right? So you earned 2,000 rupees less. So you earned 30,000 from equity as the market went up. And because of this option strategy, you lost 2,000. So net, you earned 28,000 on the whole. As just a trader, you would have just lost a lot of money. But as an investor using options, you actually had it hedged. That's why it's called covered call. You're covering the call with an actual position backed by it. You won't be surprised to know a lot of long-term investors, hedge funds, etc. use this strategy to actually earn a little bit more. Now, there are a little more sophisticated systems which are monitoring risk really well. But imagine this, right? If you're owning a long-term stock and you think most of the time markets don't trend, this makes perfect sense. But you're probably wondering, how do I find what stock to buy in the long term in the first place? And I know that's a problem. That's why I have a solution for you. Simply go to the description and click on this link. A form will open up. Fill up this form dutifully because only a few people can actually get in. It's called LearnApp Prime. What we've done is we've made 0 to intermediate education with an actual mentor and a teaching assistant every single weekend on how to build a portfolio, how to trade absolutely free. But to prevent freeloaders from coming in, we have this form to make sure only the right people come. So over the weekend, you will not only learn the basics of technical analysis and trading, you will also build an actual strategy. And there will be an assignment, you will complete the assignment with a teaching assistant, and hopefully you will actually learn something amazing. Tens of thousands of people have taken LearnApp Prime, and you should too. The only requirement is that you be fully sincere. But there's one more thing I wanted to convert over here, and that is the worst case scenario. So what if Reliance went from this 2,600 something to 3,000 and you've shorted that damn call? As you can see, the calculation is very simple. In equity, you would have made this much multiplied by 200 shares because equity went up to 3,000. The call options would have gone from 25 to this number right here, and if you multiply this, you get your total loss. If you subtract it, even then you still make some profit. Did you make the entire run up in equity? Absolutely not. But you made some money still, but you made lesser money. So your maximum profit is capped at 28,000 rupees, no matter where the market goes. So the advantage is very simple. If you have a long-term view and you think most months the markets are sideways or down or move up just a little bit, then this strategy works excellent. If you found this video useful, let us know in the comments below so we can create more videos like this and teach you how different option strategies work in different market scenarios. And most importantly, talking about where they don't work and where they do work, because trading and investing isn't complete until you actually learn the risks. Also, I'd love to know what other kinds of strategies are you curious about. So please put something nice in the comments below. Give a like, hit subscribe, and see you in the next video. कौन सा secondary camera ये? Whoa. Guess who I am?